everyone, welcome back to our Accounting 210. In this video, we continue with the chapter 9, the master budget. So last time we talked about the production budget. We said you always start from your sales budget, and then once you get your sales budget, then you get the production budget because you get your sales plus your ending inventory that gives you total units you need minus the beginning inventory, you get the units you need to produce. And then we kind of just go through all these direct material budget, direct labor budget, and then manufacturing overhead budget. We just go through very quickly looking at this handout. The reason is, as I said, you will not be tested all the calculations, so I don't want you to spend too much time on the detail. But read your textbook, watch the video, just in case you will have a multiple choice. And then we also said that here for the first quarter, the ending inventory is ending inventory of March, and the beginning inventory is beginning inventory of January. Okay, so once we got production, right? So once we got production, we said sales minus cost of goods sold gives you gross margin, and then we need to also get our operating expense, right? We also need to get our operating expense budget. So in this video, we start with that one. We start with this operating expense budget. We said all the period cost will be expensed the same time when they incur. So this is called the operating expense or the non-manufacturing costs. So let's say what you want to. Some examples, they are sales commission, right? So now you totally will sell 30,000 units, and then when the salesperson they sell one unit, they get $1.5, so you get 45,000 as sales commission. You also have a shipping, so you also have a shipping cost. Those are all operating costs. Those are not production costs. Okay, here is the one I kind of want to point out is that you also have some sales, some revenues you may not collected when you have the credit sales, right? When you have credit sales. So we have this expense called bad debt expense. I hope you still remember this one from your financial accounting. Bad debt expense. So that is the portion you cannot collect from your credit sales. So this is not the overall sales, it's only from credit sales. That is why when we first do our sales budget, remember all the way up, we said when we do our sales budget, we mentioned 80% will be credit sales, and then we totally have this 480,000. And then we said we predicted 1% will never be collected. So that 4,800 will be our bad debt expense. It only depends on our credit sales. It's not the total sales. Cash sale will never have a bad debt. You only have bad debt for your credit sales. Okay, so this is one of the things I want to point out here. Then you can find out that you have sales commission, you have shipping, you have bad debt expense, 1% of the credit sales. So you have all these variable operating expense, you have all these fixed operating expense, you got your total operating expense. Now we have everything we need to prepare our budgeted income statement, right? To prepare our budgeted income statement. We have our sales revenue from the sales budget minus cost of goods sold from the production budget. We got our gross profit minus all this operating expense. We get our operating income. Then you also have interest or tax. You got your net income. I'm not going to talk about cost of goods sold here, so you don't need to worry too much about this part. So once you finish the income statement, actually just off focus on this operating income. Once you understand everything up there, you are good. You don't need to worry about anything from there. Okay, so this is what we have covered for our operating budget. For our operating budget, we go back one more time. Remember when we started this chapter, we said this is our operating budget. We always start from the sales budget. From sales budget, we got our production budget. So one more time, we review together sales plus your required ending inventory, get the units you need, minus the beginning inventory, you get the units you will produce. So once you have production budget, you can do direct material budget, direct labor budget, and manufacturing overhead budget. So those are one group, right? And then you also have operating budget, operating expense budget. One thing is bad debt expense. It's related with your credit sales, related with your credit sales. Bad debt expense related with your credit sales. So once you have that, revenue minus cost of goods sold gives you gross margin minus your operating expense gives you budgeted income statement. Budgeted income statement. Okay, I hope you feel better, kind of got the idea of chapter 9, and then we will do similar things for our financial budget. I see you next video and let me know if you have any questions. Thank you. Bye-bye.